It's become a lot easier to find great dividend yields in today's market. Stocks that were paying 3 or 4% a couple of years ago are now paying 5 or 6% in a completely sustainable way. And one area of the market that has historically paid very high dividends that are even more appealing right now are mortgage REITs. Most real estate investment trusts are in a category called equity REITs that invest in physical properties. Some buy hotels, some buy retail properties, etc. Mortgage REITs invest in financial instruments. They own the mortgages that are on people's houses, that are on commercial properties, and they are treated as real estate investment trusts as well. And it's not uncommon to find yields that are significantly over 10% and have been for years. So I'm generally not a fan of mortgage REITs as a long-term investment, and for a few reasons. And Tyler, I'm guessing you're not either.
I mean, if I were to look at the total returns of most of the mortgage REITs, I think that explains most of it. It has not exactly, for the past 10 years, been a market that is generous, I guess, if you will, or even conducive to being a mortgage REIT.
There are a couple of risk factors that investors should be aware of with these. And not all mortgage REITs are built the same. Some own what are called agency mortgages, which are like the mortgage on my house that's backed by Fannie Mae or Freddie Mac. And the problem is, in order to produce acceptable returns that would cover their big yields, they have to use a lot of leverage there. So if the mortgage company has if the mortgage REIT has, say, $2 billion of total capital, they might buy $10 billion worth of mortgages and finance the rest with short-term borrowing. The problem is, if you're borrowing short-term to finance long-term instruments like mortgages and interest rates rise, then you'll see the spread between the profit margin go away and eventually invert. On the other hand, if rates plunge really quickly, you have prepayment risk. Right now, if a mortgage REIT has a portfolio of mortgages at 6 or 7%, like is the prevailing rate right now, and people pay those off because now they can refinance at 4 or 5%, well, all these mortgages they just bought are no longer paying them any interest. So there's another side of it where some mortgage REITs don't use a lot of leverage because they buy high-yielding instruments like commercial mortgages, which generally pay a whole lot more, or fix and flip loans or things like that. Those have a lot of default risk to worry about. Agency mortgages are essentially default proof. That's kind of why Freddie Mac and Fannie Mae buy them. But with commercial mortgages and renovation loans and things like that, they're not backed by any government entity or other agencies. So there's a lot of default risk in the portfolio. Just a couple of examples, and Tyler mentioned the long-term performance. Annaly Capital Management, ticker symbol NLY, is the oldest and biggest mortgage REIT in the country. They're primarily an agency mortgage REIT. Over the past 10 years, their total return has been 38% over the past 10 years, compared to 220% for the S&P. It is currently yielding about 13%, but don't be fooled by that. That 38% over 10 years includes all of those dividends. There's another one called Blackstone Mortgage Trust. It's a good example of a commercial mortgage REIT that doesn't use a lot of leverage. It has a 10.9% yield, and it has still, over the past 10 years, delivered less than half of the total return of the S&P 500. Now, to be fair, that hasn't always been the case. The 10-year period from, say, 2000 to 2010, most of these mortgage REITs significantly outperformed the market because conditions were pretty ideal. Rates were falling, but falling in a kind of controlled manner, not plunging. So prepayment risk was really manageable and things like that. So I think Tyler would agree that there is a good case to be made that over the next 10 years, these could outperform. But there's just, I feel like they're kind of not rigged to fail, but they're kind of, the odds are stacked against them.
Yeah, I would say their outperformance is wholly predicated on a basically very long, flat interest rate environment where basically it doesn't change for a really long time. That is basically the ideal environment for mortgage REITs, right? Because then if you're long-term, rates are this and your short-term rates are this, and they never move. It's like, cash out spread and hit the golf course by 3 o'clock. But in these volatile, changing environments, like basically post-great financial crisis, we had a huge collapse for mortgage REITs because they had to cut interest rates to the floor to kind of stimulate the economy. And at the same time, there was a lot of mortgage defaults. So those two things combined basically wreaked havoc on dividends. This most recent one, like we said, giant increase in interest rates in recent years, which, I think I saw a statistic, more than 80% of mortgages in the United States today still have a less than 4% interest rates. And so if I'm borrowing short-term money at 5, 6, or 4 or 5%, and all of these, cheap, less profitable mortgages are on my books, then I'm making, even if I do get able to sign a bunch of 7% mortgages, I'm still not making up the difference. And so that's where the problems have come from. And if it were to outperform, like I said, it's just going to require this extremely stable interest rate environment that we just haven't had. And who knows? We'll see. But history doesn't suggest stable interest rates for 10 years at a time.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.